Have you ever wondered what happens when the system that holds everything together starts to quietly fall apart? When numbers that used to move in harmony begin to drift in opposite directions, like two continents slowly breaking away from each other? Most people don't notice it at first. The charts still look healthy, the headlines still sound optimistic, and the stock market keeps climbing as if nothing has changed. But beneath the surface, something is shifting. Something deeper. Something that can't be solved by a simple economic reset. What's coming next will not just rebalance the system, it will shatter the illusion that the system itself was ever stable. So stay until the end to really understand what's happening. Leave a like and let's start. For the first time in decades, we are witnessing a strange and dangerous split in the data that tells us how people feel about their future. On one side, consumer confidence in the stock market is at one of the highest levels in over 30 years, higher even than during the euphoric bubble of the early 2000s. But on the other side, surveys show that people have almost never been more pessimistic about their own financial lives. The gap between how we feel about the market and how we feel about ourselves has never been this wide. It's as if people are saying, the economy looks great, but I can't seem to get ahead. And that contradiction is not just an emotional one, it's mathematical, it's structural. It's the beginning of a collapse in balance that every great financial power eventually faces. To understand why this is happening, let's look at the foundation of wealth itself: income. From the 1960s until the late 2000s, the average real personal income in the United States, meaning what people earned after adjusting for inflation, grew at a steady pace of roughly 2.8% a year. It wasn't spectacular growth, but it was reliable. Families could plan their futures. They could buy homes, send their kids to college, and even save a little for retirement. Then came the financial crisis of 2008. Since then, something has broken in that long-term pattern. Real incomes have failed to keep up with the trajectory that people once expected. Imagine someone in 1999 expecting that by 2020, their salary would have risen, according to the same steady line of growth that had held true for half a century. But the reality turned out very different. Wages fell short, expectations were crushed, and that disappointment has quietly compounded ever since. Now take another person in 2015, imagining what their income would look like 10 years later, by 2025. The numbers again fall short of the line. The story repeats. People keep waiting for their paychecks to catch up with the promises of the past, but the distance only grows wider. And yet, during the same period, something very different was happening to those who owned assets: stocks, real estate, crypto, gold. Anything that could compound wealth began to rise far faster than incomes ever could. Since 2010, real personal income has grown by roughly 50%. But the S&P 500, adjusted for inflation, has surged by almost 300%. Think about that for a second. The stock market outpaced people's real earnings 6 times over. So while most households were fighting to stay in the same place, a smaller group was quietly building empires through the compounding of assets that fed off the very system that kept wages stagnant. This imbalance between the real economy and the financial economy can't continue forever. It's like stretching an elastic band. The farther it's pulled apart, the greater the tension. And eventually, something snaps. Many believe that snap will come in the form of an economic reset, a violent moment when assets reprice, debts are wiped, and the system starts over. But what's coming is not just a reset, it's a reckoning. Because resets fix numbers. Reckonings change the rules. To see why, let's step back and look at how money flows through the system. Just a little break, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below. Back to before. Decades ago, the average American saved around 13% of their income. That meant families had a cushion. They had the ability to withstand shocks, to invest, to grow. But today, the personal savings rate is hovering near 4%, one of the lowest in modern history. At the same time, corporate profit margins have been rising relentlessly. That's not just a coincidence, it's a mirror image. The more corporate profits expand, the smaller the share of income left in people's pockets. Companies reinvest their profits into financial assets, stocks, real estate, and speculative instruments. But wage earners don't. they spend almost everything they earn just to keep up with the rising cost of living. So the money keeps circulating in a closed financial loop at the top, while the bottom half of the population watches prices climb faster than their paychecks. Nowhere is this more visible than in housing. For most of the last 60 years, the average home in the United States cost roughly 4 times the yearly household income. But since the late 1990s, that ratio has soared to 7. In other words, the average home is now almost twice as unaffordable as it used to be. Housing, shelter, the most basic human necessity, has become a luxury asset. And because housing represents the largest single component of the consumer price index, this distortion has a massive ripple effect. When people spend most of their income on rent or mortgages, they can't save, they can't invest, and they can't participate in the compounding that builds real wealth. They're locked out of the game. Meanwhile, those who already own property see their wealth multiply with every new record high. It's not just an inequality of income anymore, it's an inequality of access to the engine of wealth itself. This is how an economy slowly turns on itself. Over time, the average person loses hope. Back in the year 2000, about 75% of Americans believed they had a good chance of improving their standard of living. By 2010, that number had fallen to 50%. Today, it's closer to 25%. That's not a small shift. That's a collapse in optimism. And when optimism dies, economies stop growing organically. They grow through credit, speculation, and manipulation. That's where we are now. A financial system that runs on borrowed time, borrowed money, and borrowed confidence. And yet this isn't the first time it's happened. History has already shown us what comes next. In the late 1920s, wealth inequality in America was at its highest level in modern history. The top fraction of a percent controlled a massive share of the nation's wealth. Sound familiar? The stock market was booming, fueled by speculation and cheap credit. But underneath it all, wages were stagnating, savings were shrinking, and housing was becoming unaffordable. The result was inevitable. The market crashed, asset prices collapsed, and wealth inequality was violently reversed. What followed wasn't just an economic reset, it was a total rewiring of the system. After the crash, corporate taxes rose sharply, squeezing profits and forcing a redistribution of wealth through government programs and social reforms. It was painful. It caused unemployment, business failures, and widespread fear. But it also gave birth to the longest period of broad middle-class prosperity in American history. From the 1940s through the 1970s, wealth inequality stayed low, wages grew alongside productivity, and people once again believed in the promise of the future. But that balance began to shift again in the 1980s, when corporate taxes were cut, profits exploded, and asset prices began another long rise. Since then, the pattern has repeated. Higher corporate margins, lower savings, rising inequality, and booming markets. The very conditions that lead to crashes are building again. So when we talk about a coming reset, we have to understand what that really means. A reset implies that the system can correct itself and continue. But what's forming now may not be correctable through the usual mechanisms. Because the problem is no longer just financial. It's structural, psychological, and generational. The disconnect between the rich and the rest, between the markets and reality, between numbers and human lives, has become too vast to reconcile without something breaking at the core. Imagine a bridge designed to hold a certain weight. For decades, that bridge carried more and more load, cars, trucks, people, without collapsing. Engineers kept patching cracks, reinforcing beams, and telling everyone it was fine. But at some point, the foundation itself begins to rot. You can repaint the surface, you can repair the railing, but if the pillars beneath are crumbling, one day the bridge just gives way. That's where the global economy stands today. The cracks are visible in every chart and every household budget. The divergence between asset prices and real wages is not sustainable. The illusion of stability has lasted longer than it should have. But when it breaks, it will not look like a traditional market crash. It will look like a rewriting of how value itself is measured. Let's take a calm look at what that could mean in practice. If the next phase were just an economic reset, we might see a sharp fall in asset prices, a temporary recession, and then a new cycle of growth. Painful, yes, but manageable. What's worse than that, however, is the collapse of trust. Because once people stop believing that the system is fair or even functional, money itself loses meaning. Inflation, deflation, digital currencies, political turmoil, all of these are symptoms of the same disease: loss of faith. When citizens no longer believe that working harder will improve their lives, when investors no longer believe the numbers on a balance sheet, and when governments no longer believe they can stabilise their currencies without printing more of them, that's when resets turn into restructurings. That's when the rules change. We're already seeing early signs of this everywhere. Nations racing to digitise their currencies, central banks quietly preparing for programmable money, a world where savings can be frozen, spending can be tracked, and wealth can be redistributed at the touch of a button. Some will see this as a solution, others as control. But either way, it represents a level of systemic transformation far beyond a simple economic reset. It's the birth of an entirely new framework for how wealth, labour, and ownership function. And just as the Great Depression reshaped the 20th century, this transformation will define the 21st. Now take a breath, because even though all of this sounds frightening, it's also a moment of truth. The patterns we see today, the divergence between income and assets, the fall of savings, the rise of inequality, and the illusion of prosperity, are not random. They are signals. They are warnings that the system is demanding balance, and it will achieve it one way or another. The question is whether that balance comes through gentle reform or violent correction. And history tells us that when those in power ignore the signals, correction always wins. Let's imagine what this might look like over the next few years. Oh, and I remember you that if you want to build a YouTube channel like this, you can join my free Telegram community with the link below, back to before. At first, nothing obvious will happen. The markets will still be near their highs. Governments will insist that inflation is under control. People will still buy, spend, and live as if things are normal. But slowly, liquidity will tighten, credit will dry up. The smallest cracks, defaults, layoffs, bankruptcies will begin to appear. Confidence will erode, and suddenly, the realization will hit. The economy isn't resetting. It's transforming. The rules of ownership, taxation, and even currency will begin to shift. And once those rules change, the past no longer provides a map for the future. So if what's coming is worse than an economic reset, what exactly should we expect? We should expect uncertainty to become the new normal. We should expect money itself to evolve, possibly into something digital, programmable, and centrally controlled. We should expect governments to take a far larger role in managing private wealth, not because they want to, but because they'll have to. And we should expect individuals to be forced into choosing between adaptation and resistance. Those who understand compounding, value, and independence will survive. Those who rely on the system to protect them may not. But here's the calm truth in all this chaos. Every transformation, no matter how brutal, carries opportunity for those who see it clearly. The same way the crash of the 1930s paved the way for a generation of builders, inventors, and investors who created new wealth from the ashes. This next era will also reward those who prepare rather than panic. It won't be easy, and it won't be short, but clarity has always been the strongest currency in times of change. So as we move closer to this breaking point, remember this: resets fix numbers, but transformations rewrite them. What's coming will not be a return to normal. It will be the creation of a new normal, one where the old definitions of money, work, and wealth no longer apply. And if history is any guide, those who sense the shift before it happens will not only survive it, they'll shape what comes after. Because the truth is simple. Every empire, every system, every age eventually faces its reckoning. And this time it won't be just an economic reset. It will be something far greater, something far deeper. What's coming will change everything, like what will change if you subscribe to this channel. So smash that subscribe and like button, let me know your thoughts in the comments. And I also want to remind you that if you want to build a YouTube channel, like the one you're watching now, and make money from it, I opened a free Telegram community with the link below. See you there or in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.